Hi everyone, this is Daniel Dusina from Blue Chip Partners, and I'm very excited today to launch a new series for you all. This series will provide a look behind the curtain at the deep dive investment reviews that take place within the firm's internal investment committee. These investment reviews may take place for a number of reasons. They could be due to underperformance or outperformance of a specific company. They could be due to a company receiving overly attractive or overly unattractive rankings from our investment committee that when these rankings are conducted on a bi-monthly basis, or it could just be because we have found a new opportunity and we want to weigh that opportunity against some of the other firms that are currently allocated to within our internal models. So without further ado, I will embark on this first rendition of our peek behind the curtain. And we'll be starting with Texas Instruments, which was reviewed back in April of 2023, before moving on to KLA and ASML, which were reviewed in late August. Specifically with regards to Texas Instruments, this company ended up being reviewed back in April because it had consistently received poor scores from the investment committee on average when the investment committee ranked each of our holdings within our core equity model on a bi-monthly basis. So this happened twice in a row where Texas Instruments resided near the bottom, and so that warrants some investigation. And what we found with Texas Instruments, which really has been a relatively long-term holding for us, wasn't anything overwhelmingly negative, but it also wasn't overwhelmingly positive either. Texas Instruments is a bit of an outlier within the information technology sector, just given the fact that it is incredibly shareholder friendly. What I mean when I say shareholder friendly is that it places a very large emphasis on returning cash to shareholders, both through dividends and buybacks. So it may not be the biggest grower, given it is participating in the analog semiconductor space, relatively unsophisticated chips, steady Eddie type growth. It's also returning a fair amount of cash to shareholders, and we would kind of view it in terms of high quality in that lens. The bigger concern that we walked away from this review with was, however, the fact that they are really ramping up their capital expenditures over the next 3 to 5 years. So much so that we started to have some concerns around what that actually means for that shareholder friendliness of the company. That guidance of increased capital expenditures hadn't really affected investor sentiment on the stock, but we were just wondering how long it would take and how patient investors would really be willing to be, especially considering this significant uptick in capital expenditures can end up affecting profitability and ultimately free cash flow, which then in turn can impact how much cash Texas Instruments can return to shareholders. Maybe not necessarily through dividends. We think those will remain healthy, but more of a concern around halting buybacks, which are another form of shareholder return. So, like I said, not overly negative, but certainly not overwhelmingly positive either. So that was a name that remained kind of in our probation list, if you will, one that was viewed on the lower level of attractiveness by our investment committee. Fast forward 4 months, and we decided to review two companies, KLA and ASML, because within our conversations and research, we have kind of uncovered these two companies that we found to be attractive, and wanted to see if they would potentially be a good fit for our internal models and ultimately for clients, in place of something else or just as a simple addition. And taking a step back and discussing where these two firms play within the business landscape, both of these firms, KLA and ASML, are both within the semiconductor equipment industry. So specifically, these firms are providing equipment to aid in the semiconductor manufacturing process. And although they're both in the same industry, they provide very different goods and services. We'll start with KLA. KLA is very unique because of how integrated it is within the entire manufacturing process. The semiconductor manufacturing process, although it's very complicated, it can be distilled into 3 simple steps: deposition, lithography, and etching and cleaning, as they're shown on the slide here. Deposition is really just layering down some chemicals and additional materials on a silicon wafer. The lithography phase is more implementing or imprinting a design onto that wafer through high-tech laser machines. And then finally, this etching and cleaning phase is really more about just kind of chipping away any excess material, so you end up with that nice square chip that a lot of us have seen. So understanding this process, these 3 phases, the reason why we really like KLA is because they are not necessarily just tied to a single phase. They are insulated and taking place their machines are taking place between and within each one of these three phases. So the process control or quality control element, that's the type of machines that KLA produces. And these are essential because a chip can't keep passing down the supply chain or down the assembly line, if you will, if it does not meet certain standards. And KLA's machines aim to quantify if those chips are meeting them or not. So very well integrated, and it's also worth noting that they hold over a 50% market share in this process control segment. They have held over a 50% market share for over 20 years. Very well tenured management team. And really just if you think the semiconductor sector or industry is going to grow in the future, it's almost impossible to not see KLA growing. Flipping over to ASML, ASML is segmented in one specific portion of the semiconductor manufacturing process, and that's that second phase, lithography, that you see on the screen here. The reason why we like it, though, even though it's kind of just segmented in that one phase, is that this business is essentially a monopoly. You can see on the slide that they have over a 90% share of the lithography market. And that's important to note because there are very high barriers to entry in this specific part of the semiconductor manufacturing process. These high-tech machines can cost upwards of $200 million a piece. So ASML may only sell 30 machines a year. These machines are as big as a bus. They are incredibly complicated, and to have a stranglehold on this type of industry is very unique. And so it's not very likely that this firm, ASML, will be encroached upon from a competitive standpoint. Although Chinese manufacturers are attempting to do so, the level of technology that is required is same as KLA. If you do envision the semiconductor industry growing in the future, it is impossible to envision that happening without ASML also growing. So overall, when we looked at these two businesses, we came away with a very favorable outlook. And that being said, we wanted to make sure we weren't just overloading our internal models and ultimately client accounts with exposure to information technology as a sector. That being said, we looked back through what might be a potential source of funds, and given what we talked about with Texas Instruments just a few months prior, we arrived at the decision to remove Texas Instruments from internal models and client accounts and replace them with half positions in KLA and ASML. Not saying that we have an outright dislike or negative outlook for Texas Instruments, but really your opportunity cost of continuing to hold Texas Instruments is that you are not holding KLA and ASML. We would much rather expose our clients to secular trends instead of some of the short-term headwinds that we view from Texas Instruments. Thank you all very much for watching this first edition of A Peek Behind the Curtain at our investment reviews. We look forward to providing some more insight and shedding some more light on what happens behind the scenes within our internal investment committee.